So before we will enter to our subject of discussion, let me discuss few things on the this week's trend report what we have given as per the one standard deviation. So this is the 3rd March. This report is being given for 6th to 10th. Today is the last trading day. In fact, during this particular week, Nifty was range bound, and this is the first target 9,005, and these are the downside first target also 8857. So this is what Nifty has given. And in fact, if you can see today, so far Nifty has made 9,003 as high. And if you look into the Bank Nifty, I think 2 or 3 level of target it has achieved. So third target was 20,944, and till now, till 10 o'clock, we have achieved in the Bank Nifty till 20,933, 10 points less from our third target, and some trailings also trigger. So this is what this week's trade report what we have given. This is what happened till 10 o'clock. Now moving into our session, wherein I have told you that these are the days, the election outcome day, Federal Reserve days, all these days are known as the critical days. Why these days are known as the critical days? Because in these days, majority of the traders are indecisive in nature. The outcome of that particular event is going to guide the trend. So that is what the critical nature of this kind of market. So what happens in such kind of critical days? So why I am just giving a name critical day? Reason, this election result, this kind of domestic event is one of the critical day. However, you have many different kind of critical days like your Federal Reserve's interest rate policy, RBI's review, so that is also classified as the critical days. So on those critical days, how market behaves, especially the option instrument. Normally, on those kind of events, many possible news used to surface. One group of bankers, financial institutions, they argue that the outcome will be something, and one group give a contrasting view on that outcome. So when the outcome of an event is having ambiguity or not having a clear view, on those kind of events we classify as the critical days. So on these critical days, before those critical days, the IVs of those options used to be very high, and post that event, there is a sudden fall in the IV used to happen. The implied volatility option used to fall rapidly post that event, and there is a huge price swing also used to happen in the underlying asset. So that is the first reaction of those kind of critical days. So this one standard deviation principle helps you a lot on this kind of days, because this is a temporary phenomena of implied volatility, the temporary phenomena of the volatility rise. Those are the things also used to be taken care of by the Gart's method, which can project a correct estimation of volatility, and it works in the critical days also. So using that particular one standard deviation method, how we can make use of or form specific option strategies. So first let me classify the option strategies. Which are the strategies normally works in this kind of critical days? Because I have told you that implied volatility used to decay rapidly during this post that event. So we must have couple of strategies which can work on those kind of things. So that is ratio calendar call spread or ratio calendar put spread. Both also you can take. So ratio calendar call spread, put spread, whenever I am talking. So you have to buy one lot of call option, buy one lot call, preferably in the money or at the money, in the money or at the money options. So this is only one lot you have to buy, and simultaneously you have to sell two lots of call option have out of money or put option of out of money. So this choice of in the money call option and choice of out of money call option should be taken from the one standard deviation trend points. This is one. Second, cross calendar call spread or put spread. Cross calendar call spread, put spread, whenever I am talking. So here you have to buy one lot of call option, preferably same in the money or at the money, in the money or at the money. So one lot you have to buy, and this one lot should be from the current month. Current month means if we are in the March, it should be in the March, and you have to sell a call option of out of money, that too also one lot, that is for the next month. So next month means it is for the April. So for March month you have to buy one lot, and April you have to sell. The nature of those options will be, the buying options will be in the nature of in the money or at the money. The selling option will be out of money, and both will be in the different series, and these two choice of the strike also purely depend upon the one standard deviation trend points. Third strategy is net credit call and put spread at the trend termination points. So as per the one standard deviation, wherever the trend is terminating, trend is maturing, at that point you can form a net credit call spread or put spread. When net credit call spread I am talking, the nature of this particular strategy will be buy the call option of current month. So this is for March, and that too also one lot, and sell a call option of April, that too also one lot of same strike. So you can receive the credit, net credit. So next month option will be having higher premium, you will be receiving. Current month will be having the lower premium, which you will be giving. So your net will be credit. That too also using the one standard deviation trend termination point. This is very important. Trend termination point. So the decision of strike should be from the trend termination point. The fourth strategy what you can take is future long with deep in the money put option and deep out of money put option long. So this also as per the 1SD trend determination points. So these are the strategies you can take, and the simplest is the fourth one. Fourth one is the simplest, but the time value decay factor will be more in the fourth. So if the price move doesn't happen wildly, then what happens, this kind of the last strategy results the maximum loss. So we'll just look into those factors and we'll just simulate on that proportion how to form these strategies one by one. So let us have a look on these trend calculations as per the one standard deviation. So here I have to open this. So this particular, have a look at this trend parameter which I have taken yesterday when post market close. So this is for 8956. Yesterday the Nifty future has closed. At that period itself I have just generated this level, and positional we have taken maximum 10 days we can utilize. I'm just taking for 7 days. So 7 days. So Friday I need to initiate. So I need a real-time volatility. So real-time volatility also is being identified as per my software. Yesterday in post-market hour I have generated. Today I am going to initiate that strategy. So here if I am just taking into the consideration of my uptrend and downtrend termination point, Maximum I can go for 9,300 here for the next week post this event. Same way, minimum I can fall down to 8579 level, the decay cluster of the downtrend third cycle. So this is the two trend termination points, and my uptrend is setting at 8484 level and downtrend. So 8984 level and 8927 level is the downtrend. This is what the information is there in my hand. Using this particular outcomes, I am going to form my strategies. So this is the trend analysis I have done using the OneHD software. Yesterday 9 o'clock, it means 9th of March, and that too post market hour, because I am going to utilize these particular levels for today. I have used the number of holding days as 7 because this event is falling very quickly. However, I will just take 7 days so that I can get some more freedom to, or 7 days you can take, 5 days also you can take. So though you are having some 2 to 3 days, but less than 3 days if you are taking, you may not get a proper estimation of third cycle. So better take some higher levels, 5 or 7. So I have chosen 7 days. So after choosing these 7 days, I got these price points. Only the termination price points are very important for me. So 9,200 also one termination, 9,350 also one termination, 9,040 also one termination. All these growth calls clusters and decay cluster price points I am focusing on. So I am going to form option strategy one by one. All this strategy whatever I have told you. Ratio calendar call spread. Ratio calendar call spread what, or put spread what I am going to form. So this strategy will be translated in this order. So here I have just seen the levels. So 9343 level, and here 8984 level, and so here 8927. So these levels are very important for me. So I am going to do the strategy in this order. I'll be buying one lot Nifty. So the first strategy what I'm taking. So let me go down, and so let me do it in an Excel sheet. It will be better. So here I'll be buying 9,000 call one lot. Also I'll be buying 8,900 put one lot. So this is for March. This is also March. So after buying these things, I need to sell. I'll sell 9,300 call two lots of April, and I'll be selling here too 8,600 it is coming, 8,600 put two lots of April. So this is my first strategy. So let me estimate these things with my option strategy builder software. I'll go for the user defined calendar spread strategies. I'll just index future. I'll be choosing Nifty. I'll be loading the data. So here too, I can choose 9,400 strike also I can choose. So this is also last target here. 9343 is there. 9350 also I can choose. So let me choose those strikes what I have decided. Call option, I'll be buying 9,000. So one lot. And next month April, call option of strike 9,300. So that two lots I'll be selling. Same 7 days estimation of trend I have taken. 7 days I'll be giving here. I'll be just calculating this thing. So in case of a uptrend I'm getting, so here In case of a uptrend, so these are the price points it is giving me. So I can say if it is going for a 9,300 level, 9,300 level, post my entry. So I may be landing up some losses here. So this is giving me 9,300 level also losses. I'll go for the put options. Out of this four, anything is better for me. I can take. I can just go for 9,000 put option buy, and also same way I can put option strike 8,600. That to sell 2 lots. Number of lots 2, number of lots is 1. So 7 days calculate. So this only this one is telling me if I am falling to 8,700 level, then I'll be having profit. I'll be having a profit here. So 8,700 level, it is giving you 4,000 plus profit. And if it is going to 9,200 level, then this is the losses it is projecting for me. So 2 lots of this thing, whatever the remaining part of the money is there. So I am getting just 100 and 130 I am paying. So this will not become zero because this is the next month's option. So in fact I will be landing up a loss in uptrend, and call option also in case of a uptrend I am landing up a loss. So I will be just rejecting this particular strategy based on this current volatility structure, because the call combination is giving me loss in case of a rise or a fall, and the put combination is giving me a profit in case of a falling market, and it is giving me a loss at rising market. So this is a loss in rising market and profit in the falling market, and this is loss in both the markets, rising as well as falling. So I'll reject this ratio calendar call spread. Cross calendar call spread and put spread, same way we have to form cross calendar call spread and put spread. However, what happens here in cross calendar call spread and put spread, just this part will be reduced. So here, just moving to the strategy. So 9,000 put, buy 1 lot, this will become 1 lot. So 1 lot. So if I just calculate fantastic profit if I am getting in case of a falling trend, 8,700 level. So 7,000 profit, rising market, it is at a loss. So 5,000 loss it is giving. So let me see the call combination what it gives me. 9,000 buy 1 lot, and here call option 9,300 buy sell, and that to 1 lot. IV difference you can find out 11.71, 10.24, calculate. So this is in the uptrend it is 5,000, in case of downtrend it is 3,000. So in either case 3 to 4,000 rupees gain I am making in the second strategy. So second strategy, once I am just inserting, excuse me. So second strategy, it gives me a profit, cross calendar, call spread and put spread. So the same strategy here, termination points you have taken as per one standard deviation. Here just the number of lots is 1. So number of lots is 1. Here too also number of lots is 1. And in case of a rising market, the first call combination is at a profit, and we are getting a profit estimation of 5,500 plus. Same time the put combinations. So the put combinations, so I have taken here 8,900. So here I need to change a little bit. So the put combinations is at a loss here. So put combination is at a loss. So this is also loss. So net is coming some profit. So net is profit. And in case of a falling market, the first combination, call combination is means the sell of 9,300 and 9,000, 8,900 and 8,600. So these two also in profit. So I can just also say this is one of the strategy. I can keep it in my basket. So this is giving me profit, so I can keep it in basket. So this is also giving me profit. Third strategy is net credit call and put spread at trend termination points. So where is your trend termination point? 9,300 or 8,600. So this is what I am going to do now. So same 9,300 call option, I will be buying one lot, and 9,300 call option, I will be selling one lot. So this is the strategy. In case of a falling trend, good gain is there, 2,000 plus gain is coming, and 8,600 I can take. So put option 8,600. So here to buy one lot for March and put option for 8,600. Let us sell one lot. 7 days. So this too also in uptrend market gives a good profit. So this strategy also I can take net credit, very low risk strategy. So this too also in case of a wild swing either in the upper side or in the downside, upper side we are expecting 9,300 plus, downside we are expecting 8,700. So 8,600 down. So in this case also, this is also giving a profit. So this is also not a very great profit, but profit is there. Because when we form net credit call and put spread, margin requirements is very low. If you are selling one lot call option and one lot put option of the next month and buying one lot call option and put option of current month, hardly your margin requirement 30 to 35,000 is the Nifty. So this 35,000 worth of investment, if it gives you some 2 to 2,500 return post this event, it works out to near about 10% return. So it's not a bad return. Cross calendar spread also similar kind of margin, it will take 45 to 46,000, and if you can earn some 3 to 4,000 rupees for one strategy, that also work out to 10% of profit on your this thing, on your investment. And you are having the major benefit of this particular thing is you are having zero exposure to the IV decay. You have almost zero exposure to the IV decay. So if there is no great move happens in the market, still you will be spared the zero exposure to IV decay, because this kind of critical days post the event is over, you will find out the IV decay. Maybe Saturday the election results are over, Monday itself, opening itself, all the IVs will decay with a wild swing in the price. Price will be with a wild swing in the price, the IVs will decay. So for that we have just consolidated on 4 strategies. Out of this, the first strategy, ratio calendar call spread and using honesty, in both the rising and falling market, it has given loss. So I have just ignored these things. This is, though this strategy is suitable for this kind of market, but current volatility parameter doesn't permit this strategy. However, cross calendar spread with its margin, considering the margin you will employ for this particular strategy, I'm getting 8 to 10% gain. This net credit call and put spread at a trend termination point also having the similar kind of profitability. Now coming to the last one, future long with deep in the money put option and deep out of money put option long. So this is also you can take with respect to delta zero. That also you can take with respect to the delta zero. So if you are a user of our option strategy builder software, you can look into this Greek scanner, you get all the Greek scanner. So where is our one standard deviation saying? So one standard deviation saying that 8,600, this is the price point you can get, and one standard deviation also saying that in the uptrend you have the probability for 9,300. So 9,300, this is your probability. So I'll be focusing on the put side. I'll be long in the future, which can add to delta 1. Long in future means delta as 1. So delta as 1. I'm just negating that delta with the 9,300 put option with a 0.76, and I'm just adding this 8,600 and put with a 0.10. So my delta is almost 1. So this strategy is the simplest one and having the probability to win you very great profit in case of a very wild swing. So I will be buying the future. So that is roughly at 8965 level. One lot. Simplest one. Delta is 1 now. Because future always has the 1. If you sell future, delta will be -1. If you buy the future, delta will be 1. So this is the one that we have done. Then we have to buy the 9,300 put. So 300 and something it is trading. So if I just go to the Greek scanner, I can get the data. So Greek scanner, here it says 9,300, 330. Almost similar in value of intrinsic is there. Almost zero time value, 0.76. So 330, one lot, delta is minus 0.76. Now I'll be buying one more lot of put, which is 8,600 put, by paying a premium of 20. That also one lot, which will have a delta of 0.10. This is the simplest one. So your net delta, if I can sum it off, so it is 0.14, almost zero level. In case of a wild swing, if there is a upward swing happens drastically in the upward direction, you'll be at a profit. In case of a downswing also, you'll be at a profit. Just to simulate that strategy in the software and see. So this is the references being taken 8980 level. So I'm just going for 9,300 put option buy one lot. I am buying a put option of 8,600. I am buying one lot, delta net 0. So 7 days estimation I have taken for the trend. Just take one 7 days estimation here also. So 7 days estimation also you can take it here. Load the data once more. 8966 buy one lot, put option 9,300 buy one lot, and put option of 8,600 buy one lot. So this event is the 5 days. Also I can take it. So delta net delta 0 level. As I told you, if it is having a very narrow swing, so you have that kind of things. I will be estimating at 9,300. What will be the things? 6 to 7,000 rupees gain you can get it here. So this is my optimum expectation as per the honesty trade. 6 to 7,000 gain comes at 9,300 level. If there is a wild swing, more than that you can get in fact. So, and if it is coming to 8,600, there also will be a small profit of 1,500. So more than that you can get it, because the IV of this particular option will add up more, because once it comes to 8,600 level, IV will be more, which is at a current level of 10, it may go to 12 or 13. So that is also add on to more Vega. So this though projected profit will be 1,600, maybe you will be getting some 3 to 4,000 and above. And here too also, once it goes to 9,300, though the projected profit is some 5,500, you will be getting more out of that. The reason is the 9,300, which is having a deep in the money now, having almost all money into the form of the intrinsic value will be converted a part, means minimum some 25 to or 50% of the value will be there for time value. So 7 to 8,000 also you can get. So though projected profit will be lesser because little conservative estimations we have done in the software. So for that reason only. So whatever projected is there, more than that you can get it. And whatever the projected losses is there also, it will be lesser than that. So we have just done something, a little bit of conservative estimation on the profit, little bit higher estimation on the losses side, so that you can say in case of there is a wild swing in the volatility, it should not exceed that. The losses should not exceed profit. If it is exceeding, no issue, but losses should not exceed. So for that, it is you are getting this thing. But in case there is a uptrend breakout above 9,300, what we are expecting as per one standard deviation, or if there is a downtrend breakout below 8,600, even 8,700, you will be also getting a good profit in that. Good profit in that. However, the losses when it will come, if there is a consolidation between the 8,800 to 8,800 to 9,100. So this level you have the losses. That too also post event, I'll be expecting some in the range of 1,500 to 600 to 1,500. That will be the losses. So risk reward, if you can say 1,500, if I'm just telling that the optimum loss you can get in this strategy. So maximum profit will be from the range of 3,000 to 7,000. 7,000. So 1 is to 2 to 1 is to 4 risk reward you can get it in this. So this is the simplest one. Just net delta 0 you have derived, and similar strategy you can form in the stock future also. If you have the softwares, certain stock futures which is having a little higher side of volatility, you can get benefit in this kind of strategy like ratio calendar spread, cross calendar spread. In this kind of strategies you can get more benefit. So similar kind of strategies also you can form on the strategy, on the stocks which has almost given a great run up, like Reliance type of stock which has given a great run up before this event. So you may think of initiating specific strategies which out of these 4 strategies, any one strategy you can initiate which can benefit from this market move. So all in all, we have just concluded 4 different strategies is suitable for this kind of critical dates. Reason, post-event, IV is going to decay faster. So in Nifty, I have demonstrated currently these 3 strategies: cross calendar, call spread and put spread, net credit, call and put, future long with deep in the money put and deep out of money put long. These 3 strategies giving a risk reward of 1:2, 1:3 risk reward. However, certain stocks which will be having a higher volatility. So Nifty is around 15 to 16% volatility now. So if any stock is having a higher volatility, 20 to 25 range, then you can form similar kind of strategies having a higher risk reward ratio. Higher risk reward ratio. So this also you can form in this particular method. So what you have to do, if you are a user of one standard deviation software, just go for the positional, say the number of days at 7. So load the data for that stock. So by 3 o'clock of today, you can do that. If you have not done yesterday, now also means today also you can do around 3 o'clock. Just load the data. Number of days 7, 5 also you can utilize. You can also use for 5. So just go for a calculate. You will get the trend levels. So you need the trend termination points. This is the trend termination points. Growth clusters, last prices, and where the trend is starting. So where the uptrend is starting, downtrend is starting, where it is terminating. So based on this, you can think of the strategies out of this four: cross calendar, call spread and put spread, net credit, call and put spread at trend termination point, future long with a deep in the money put and deep out of money put long. So this kind of strategies you can form now. So around 3 o'clock, you estimate by 3:30 you can initiate. So this is how you should trade on the critical days, and do remember, do not buy the options alone in this critical market situation. The IV decay is definite, it is going to happen definitely. If you just buy a call option and put option and just keep buying, both the sides you will lose the money. Similar kind of strategies also you can initiate in the Bank Nifty weekly options or in the monthly options. However, do not buy only options, call and put combination, and just wait for the event, and you will find out that net will come as a loss because of the IV decay. So all these strategies is being taken care so that the IV decay should not impact your portfolio. If you do not get the profit also, the IV decay should not affect your portfolio. So coming back to Smart Finance product and services, we have 12 products. I have just demonstrated this thing with the help of one standard deviation software and option strategy software. So one standard deviation software, I have, this is the software which you can utilize for intraday positioner, and I have utilized the option strategy software. One standard deviation software guided me for the trend calculation. Using the same trend points, I have chosen the correct strike for my options, and I can utilize here. These are the simple option strategies I have given, and here you can get these softwares and have a complete learning on the option strategies and try to implement that. If you believe on the concept that by reading, by educating myself, I can be a successful trader in the market, we have sufficient stocks for you. Our courses and softwares, starting from the very basics to the advanced concepts. So these are the, when you buy option strategy software, you get a printed book on futures and option, you get a near to 20 to 24 hours of literature to understand the option market. Also you get a real-time software. So in one standard deviation software, it is just based on one single concept, so only software you can. So everything has a separate price tag, like one standard deviation cost you 2,750 for 1 year. Option strategy software cost you 10,500 initially, then the subsequent years 3,500 renewal cost. So if you wish to buy all the products, it costs you 17,500. After discount, here you get somewhere about 60% discount, so that you can get a full stock in your hand. You will get 6 printed books, you will get 16 DVDs, you will get all our softwares, whatever is listed here, all things you will get. So here our objective is to educate you on specific concepts, valid concepts which work on the market, so that you should not be dependent on the tip providers. You should not be dependent on the TV channels, tip providers. Rather, you should do scientific trading. And this is not, we are not saying it, we are demonstrating it. I have shown you, this is the report as per the one standard deviation given on 3rd March. This is what happened today till 10 o'clock when we have started the session, till 9,003 you have achieved, and you have achieved till 20,930, some 10 points lacking from here. Very close approximate values here. So one calculation being given to you on the 3rd March, by till 10th March it is validating day on day basis. Yesterday also, if you can say Nifty closing, 8956 level it has closed, 5657 level. So this is the 8959 level it was there. So all these closing basis, days high basis, days low basis, these calculated points holds good. This is only for to demonstrate this method we are giving for Nifty and Bank Nifty. You can see the similar result in the stocks, equities, even the options. So these things you can see. So these happenings, the market acceptance of these calculations strongly says that this is a valid method for trade calculation. Strongly says that it is a valid method of trade calculation. Only thing is that if you convince with the idea, market never work on the gambling thoughts, rather market works on specific scientific concepts, then we are a right place. But if you are thinking that no, market works on only vague estimations on gambling thoughts, then we are not a company which propagates that idea. We propagate the idea that market analysis or the stock price analysis purely based on the scientific nature of its trend calculations, and trend calculations, if you can accurately do a trend calculation, definitely you will be successful on your trade. This is what I would like. And all our courses what you have got also, these are based on the unique concept. So it is not a plain technical analysis course where we will say that look at the chart, it is looking like double top, double bottom, so conclude it is a double top. We never say that. We say that for forming a double top, how many candles are required? What is the mathematical background of that? How you can calculate a trend breakout of a pattern? How you can, if the breakout given, how much targets it can give? All things you can learn in our course. Same way for the options courses also. We never say that just form a combination and just close your eyes and sit and correct. Success will come. It's not like that. You need to understand the volatility of the market. You need to understand why that volatility is now persisting in the market, and what will happen if this kind of volatility disappear after a couple of days. In such a situation, how to deal with this kind of strategies. So when to exit this kind of strategies, one question has come from Mr. Lakshmikant. He's telling when to exit this kind of strategies. You have estimated a trend of, say, as per the Nifty example I have told you, you have estimated 8,600 or 9,300 is the price swing I can expect post this event outcome. If it doesn't happen, come out of this trend. This is your expectation. However, these are the points of your expectation too. So your 9,200, 9,040, 8,724 and 8,574. These are your expected point. If any one of this price point is achieved, you will be at a profit also. So if it doesn't happen, come out, because these are the event-based strategies. Holding on to these strategies post-event is not advisable. You have just taken this strategy for an event. You have expected the price to achieve that particular target based on the decay factor of the volatility. If it doesn't happen, just come out of that strategy. The main aim is I entered a strategy with the aim to gain a profit. If I am not getting the profit also, I should not lose more. This IV, which is going to decay faster, should not affect me, should not affect my portfolio. That should be the theme of my strategy formation. So the 4 strategies what I have recommended to you, all these 4 strategies, last one is net delta 0, and all these 3 strategies, whatever is here, it is not going to affect you in case of a rapid change in the IV. So IV, if it is falling rapidly, you will not get affected. If you are not doing a trade also, just write down the strategies. Do a paper trade and experience what happens post-event. So that these type of events are the continuous phenomena. Post this election, again you have next week the Federal Reserve's interest rate policy. Similar kind of phenomena will come, similar kind of strategy you can use here. So this is a continuous event. This kind of critical market is also a continuous event. So you can take the benefit of that. But these strategies are just segregated to take the benefit of the critical market. And we have same way segregated 22 option strategies for Indian market in our future and option course. In future and option course, those who are purchasing. So you will be having a 22 option strategy for Indian market. If you master only these 22 strategies, that is enough for your option. That is enough for if you're having a few crores of capital also you can implement these strategies. So if you possess that course, you can just revisit this 22 option strategy section of that book. Just master that strategies. That is enough for your trading. So this is the product. If you have any query associated with the product of Smart Finance, or if you are confused which product is best suitable for me, you can call to all our sales number here. So 3 sales numbers is given here in the product link of our website. You can call to here, or you can also post the email to us. So our email IDs, you can get it here on the contact us. So contact us link here. You can just visit here any one of our email ID, drop your query, we'll glad to answer your queries. So this I will be ending. Thank you for attending this session. Thank you for your time.